I think the market is largely ascribing the same template that it has done since COVID, which is that there's a small time shock and it goes away very quickly because the US changes its mind. The problem this time is that it's much easier to change your mind on tariffs than it is to change your mind on a war. I think this is a much larger oil shock than the oil shock that we saw in Russia, Ukraine. From a global perspective, that's the one thing I really worry about. That's the one thing that keeps me awake, is if this oil shock transmutes into a liquidity shock and through that into an AI shock as well, that would be an additional shock that I don't think the markets are prepared. Frankly, the Indian equity market for the last many years has not been driven by foreign institutional investors. That's not something I'm worried about. They're not coming back anytime soon, and I'm not worried about them not coming back anytime soon. I am more worried about the domestic institutional investors changing their mind.
Our guest today is Bhanu Baweja, Chief Strategist at UBS Investment Bank. Bhanu has over 2 decades of experience tracking markets across the globe. We are talking to Bhanu at a time when the markets are being weighed down by concerns in the Middle East and also rising crude prices. It's Tuesday, the 24th of March. I'm your host and ET's markets editor, Nishanth Vasudevan. And this is the Morning Brief. Bhanu, welcome to the podcast. Now, these are really testing times for investors. When the war started, people thought it would be some kind of a cakewalk for the US-Israeli combo. They thought that, Iran would just crumble in a matter of days. That doesn't seem to be the case at the moment. What are your thoughts about the market's reaction to this entire conflict?
I think it's quite interesting to consider where the markets were going into this conflict, right? Across the world, India included, the view was that growth was coming in slightly better than expected, and inflation was coming in slightly lower than expected. So the growth inflation mix was extremely benign, right? And that is what led to continued inflows into the markets, particularly from domestic investors in the US, in Korea, in Brazil, in India. Continued inflows because the macro backdrop was manifest, a benign macro backdrop was manifest in pretty strong earnings expectations and the willingness to put a higher valuation. Then you get this significant shock that was completely unexpected, right? We're still, I would argue, in the early stages where I think the market is largely, although this is changing by the hour, I think the market is largely ascribing the same template that it has done since COVID, which is that there's a small time shock and it goes away very quickly because the US changes its mind. And you're going to see as a result the war being resolved very quickly. The problem this time is that it's much easier to change your mind on tariffs than it is to change your mind on a war. When the Russia-Ukraine war started in the first quarter of 2022, there was a view that Russia is going to end this war within a week. Some people even said 2 days. Now, 4 years later, that war is still being fought, right? So wars have a dynamic of their own, and they're very hard to completely change your mind on. And let's also remember that in this case, it's not just the White House that is making all the decisions, it's also Israel. And very importantly, now it's also Iran, and Iran, whose reaction function is the diametric reverse today of what it was in the last 3 years. It de-escalated every escalation in the last 3 years, and now there's a sort of a ratcheting up of escalation. So I think from a game theoretic perspective, it's really hard right now for us to see where this eventually ends up. So there's a lot of uncertainty, but there isn't that uncertainty in terms of the market's mind. The market does feel, if you look at the oil futures.
In fact, Bhanu, that's a very interesting point that you spoke about the markets comparing this particular conflict with the Russia-Ukraine war. In fact, the market reaction over there, it subsided after a few weeks. Do you see some kind of a template playing out even in this conflict in terms of the market fatigue as such?
I think the risk is that it doesn't, right? Because if you do the math of how much oil was removed from the market during Russia-Ukraine, so just to give you some numbers, In the Russia-Ukraine conflict, Russia produced about 8 million barrels a day. 6 million barrels a day were exported, right? So that was the amount of oil that was at risk. That's 6 million barrels a day. Very quickly, the market realized that that's going to find its way out of the market one way or another through the dark fleet coming to India, coming to China, and so on. So that was a potential loss of 6 million barrels a day, a loss which was not realized, and the market understood very quickly that we're not going to realize that. Compare that with where we are today. The Strait of Hormuz sees 20.5 million barrels, 6 million, 20.5 million barrels per day of crude and product transiting. Some of this is going to be made up for by pipelines. There's the East-West pipeline across Saudi. There's the Habshan Fujairah pipeline in UAE. Some of this is going to be made up for by the IEA stockpiles release of all the SPRs. But net, you're still losing 10.5 or 11 million barrels a day. 6 million barrels a day that you didn't actually lose in the Russian case, 11.5 million barrels a day that you are actually losing in this case. So I think it is not comparable. I think this is a much, much larger oil shock than the oil shock that we saw in Russia, Ukraine. And I think some markets are beginning to smell that. And these markets are the downstream markets. When I say downstream markets, I mean petrochemical products like naphtha, like urea, like jet fuel, like fuel oil. Their prices are beginning to spike. And I think they are beginning to sense that the supply of crude is going to be very, very limited. So I think we're on much thinner ice today than we were during Russia, Ukraine.
So basically, the forecast, the oil forecast of, let's say, $180 or $200 barrel, they're not really far-fetched as such.
Well, if you look at Dubai and Omani crude, we are, as we speak, we are already at 160, right? So yes, 180 and 200 are not that far-fetched. But again, I would insist that while these numbers make the headlines, oil at 180 or oil at 200, they're not that relevant. What is more relevant is where does oil settle? Because it's not the case of inflation being high for 1 month that we are worried about. If it goes to, let's say it goes to 200 and comes straight back to 70, yes, inflation will be really high, we'll have a shock in the markets, and then inflation will collapse, right? Through the second half of the year, inflation will collapse after being high in Q2. But if oil doesn't go to 200, but goes to 170 and settles at 100, that's a much, much more difficult place for markets to be. And that's what we need to worry about. Are we going back to 60? First, how long do we stay high? And then where do we regress to? Do we go back to 60? Do we go back to 70? My fear is that quite a few economies, quite a few political economies are going to judge that we need energy security.
True.
And therefore, they're going to not just invest aggressively in renewables, but they're going to try and secure their supply chains of energy. And that is probably going to mean higher reserves of not just petroleum products, but also primarily of crude. And that could keep demand for crude higher than the counterfactual before this war broke out. So the possibility of it not going back to 60, but perhaps landing even once the war is resolved, the possibility is that 60 is no longer your equilibrium. Perhaps it's closer to 80 or 90, which I think, again, from the perspective of the growth inflation mix, is slightly more problematic.
That's interesting. And of course, the consequences of higher oil prices, crude prices are well known. But there are very few discussions on the impact of high energy costs on AI investments. I mean, because, the last global cycle that we've seen, it is actually run on AI investments. What happens there?
Now we're going deep into the left tail. If you're considering that, so effectively, if I understand your question, you're asking me if this oil shock can translate into an AI shock.
True.
Here's the good news, right? The good news is that the epicenter of the AI trade is the CapEx being driven by the hyperscalers in the US, right? And that CapEx, every guidance that we're getting from them is very, very strong. Now, one way in which that gets compromised is if the costs of power running that AI CapEx get compromised, or the costs go much higher. How can that happen? If electricity prices increase significantly in the US.
True.
The good news from that perspective is about 45% of that electricity is powered by natural gas. And here's the funny thing. Natural gas in the US is actually lower since the beginning of this crisis. You wouldn't know that from natural gas prices in Europe, and certainly not natural gas prices in Asia, including India. But nat gas in the US is down, and therefore electrification costs in the US are fine. So the AI trade is fine from that perspective. The perspective that it is not fine from potentially is the financing of the capex.
Yeah.
If this oil shock leads to a significant liquidity shock, where either the Fed expectations are being ratcheted up, which is unlikely in my view, or that credit spreads through private credit, through public credit spreads begin to widen out significantly, which is more likely, that I think can compromise the AI capex trade if credit markets begin to misbehave. So far, that has not happened, which is why when I think of whether the markets are already in a state of panic, I have to say they're not. Not only are we seeing retail investors coming in and buying the dip, I see complete calm in the credit markets, which belies this idea that the markets are in a state of panic and are already priced for the worst case scenario. I don't think that's the case. So you are asking me a question which is not our base case, but it is something that from a global perspective, that's the one thing I really worry about. That's the one thing that keeps me awake, is if this oil shock transmutes into a liquidity shock and through that into an AI shock as well, that would be a secondary, an additional shock that I don't think the markets are prepared for.
Right. That's interesting. Now, Bhanu, there is an old saying in the market that wars often give you the best opportunity to buy stocks, or, the battered stocks, the distressed assets. Uh, Given the scenario that we are in, is it a time to take that bold call, or, is it too early for investors to take that view?
What we do know is that valuations, while they have adjusted lower, they have only begun to adjust from very high levels. This is true for India. This is true for the US. This is true for most sectors in the world. As I said to you, looking at valuations at a headline level is one thing, but most of the rotations in the market, which are sort of subterranean, which are below the surface, I don't think we've seen a big position adjustment in that. The move from large cap to small cap suddenly has to be reversed. I don't think that's fully happened. The move away from high quality companies to high beta companies, that rotation was taking place, needs to reverse. I don't think that's fully happened. The move away from the US to the rest of the world, including emerging markets, that rotation was taking place. I don't think that's fully reversed. So I don't think there's any asset that is pricing in distress. As we were discussing in the previous question, things like credit are still far closer to greed than they are to fear, right? So I don't think we are in distress. The one exception I could perhaps make is when you start looking at what is being priced for central banks in the front end. We're recording this in India, and in India, for instance, the RBI is now being priced for 4 hikes, and there are no cuts priced subsequently. That I think is wrong. So I think there's value emerging in fixed income, particularly in the front end of fixed income, because even if the RBI hikes 4 times, which is very, very unlikely in our opinion, it would only do so, and after that they're going to cut rates very aggressively, because I think most central banks would see this as a bigger growth shock than they would as an inflation shock. So I think over a 2-year perspective, we would look for lower rates relative to where we were before this war began, rather than higher rates. So for the front end to keep selling off, we think is wrong. So I think there's value being created there much more than in credit, and also more than in equities.
Right. Now, Bhanu, what about India? The reason I ask you this question is because investors in India are used to buying on dips. Every time there's a fall, they kind of pounce into the market and they kind of just lap up. But this time now, the backdrop is that we have almost 18 months of no returns. And at the same time, many portfolios are deep in the red. The question that everybody has in their mind is this the right time to start buying again?
Look, this is, you spoke to me earlier about AI and private credit. I said to you that was my single biggest worry globally. My single biggest worry for India is that the domestic flow that has been coming thick and fast has been vindicated again and again in buying the dip, because every time you bought the dip, the market has given you long-term, not even long-term, sort of almost instant gratification returns. Because we have been at nearly zero returns for 12 to 18 months, if we get negative returns over 2 years, I think people will begin to question that. Right? So I think there is a risk here. It's a non-trivial risk. You say to yourself that I've moved away from fixed income or fixed deposits to get into this market that I thought would give me 12% returns at the least. And in fact, I can be a little bit patient because I didn't enter yesterday. I entered 3 years back, or I entered 8 years back, and my entry price is actually quite good. But unfortunately, I do not have the patience to sit for 2 years on negative returns. So I think we do need this conflict resolved soon, not just from an earnings perspective for India, not just from a natural gas's physical ability perspective for India, but from the perspective of flows for India, which I think is actually going to be the biggest factor of them all, which we're not talking about enough. The flows keep coming in. The equity culture has changed. They have been vindicated because every time you bought the dip, you have made money. So that's been great. It's been a very good run. But we've not had this level of a shock. The last time we saw a level of shock like this was not Russia, Ukraine, was not the tariffs, it was COVID. And at the time of COVID, you saw significant easing of fiscal policy, significant easing of monetary policy. We unfortunately don't have the room for that anymore. We don't have the policy room for that anymore. So the response in the markets this time, and of course the valuation is much higher as well, and the positioning is much higher. So I think that is a serious risk for the markets, that the flow in itself becomes lower. Heaven forbid it turns negative. It already has come lower. So, I mean, if you look at the overall flow into the market, SIPs and mutual funds, it's gone from 40 crores to 25 crores, but still reasonably robust, and still quite robust as of February. So hopefully this is going to be a short-term blip, but I do not want to understate that risk. I think that is the single biggest risk for the Indian equity market, even bigger than the earnings risk.
Right. And when you talk to global asset allocators, they don't seem to be too gung-ho on India. When you talk to your clients, when you talk to the global fund managers, what is the sense that you get from them? At what levels would they start getting comfortable on India?
So look, the reason people were not, or foreign institutional investors were not, as you say, gung-ho on India, was because India missed a good chunk of the AI trade, right? But on top of that, we now get this shock where foreign institutional investors think in dollar terms. So in other words, they think not just about the level of the Nifty, but also level of dollar INR. So if the rupee is losing ground, then even if you make 7% in the market, if you lose 10% in the rupee, they are not that interested in being allocated to India. And I think that's where their thinking is right now. They're not bottom fishing right now. I don't think they're likely to come in. And by the way, if they don't come in, I don't think that's an existential threat for the Indian equity market, because frankly, the Indian equity market for the last many years has not been driven by foreign institutional investors. That's not something I'm worried about. They're not coming back anytime soon, and I'm not worried about them not coming back anytime soon. I am more worried about the domestic institutional investors changing their mind.
Sure. Now, let me shift your attention from equities to what's happening to the dollar and gold. Of course, since the war started, dollar has been appreciating, gold has fallen. What sense are you making from these ever-shifting dynamics?
Yeah, it's such an interesting world, isn't it, that you get a war and gold actually falls. But actually, if you look not just at the beginning of this war and after that, in my book, so the beginning of this war was somewhere around the 26th of January, because that's when the USS Abraham Lincoln moved into the Persian Gulf, and that's when tensions really ratcheted up, and you knew that you're going to get sort of the kinetic phase of the war begin. But let's remember what gold did before that. Between August of 2025 and January of 2026, gold went up almost 50%. Right? So we've been very bullish on gold since 2022, basically since when Russian central bank's reserves, 550 billion, were sanctioned, right? We thought that was a new era for gold. But since August of 2025, it entered a phase which I think one can describe as a bubble phase. So we were gold bulls, but even we couldn't believe how quickly gold, and even more than that, silver, platinum, palladium was moving. A lot of this was driven not by central banks, but in the last phase, it was driven by Chinese retail. So very high volatility in gold. And when you have such a high volatility asset, everybody got sucked in and everybody got positioned. I mean, in India as well, we saw gold and silver ETFs saw some of the highest inflows, almost as big as the equity inflows. When you get such aggressive inflows, it's no longer a diversifier, it is a risk position. And when you get such a big shock like the war, the first thing you do is that you cut your risk positions, you moderate your risk positions. And that's the context in which gold is suffering right now. Also because the dollar, the US economy, although the US is probably sort of a key party in the conflict, you can't deny that the US is an energy producer. It benefits from it. And that's why people are rushing back into the dollar. I said to you earlier, most of their positions were short dollar because they were moving away from US equities to global equities.
Right.
They're covering that position. And the sell gold has been a part of that covering of long positions. I do think there's one final leg up in gold. I think that will come, but that will need to await US yields peaking and coming lower, which I think will happen. I think, the second half of this year, hopefully we will see US yields going lower rather than US yields going higher. As I said to you, I think the market will soon begin to see it like central banks do, which is that it's a growth shock, not an inflation shock. And that will hopefully mean US yields come lower. And if they come lower, gold should go higher. And I think that's probably one last leg in the gold price moving up. But right now, I think the market is adjusting its long position, and its long position has been in gold.
Right. And beyond the, once the war gets over, what about the dollar? You think the short positions will be back?
That's harder to speculate on. I think the euro dollar will probably be quite flat. I don't think there's a very aggressive move in the dollar, but I think the places where the dollar could lose ground against currencies would be things like gold, and would be things like safe havens like gold and the yen.
Right.
Right. I see. So against those, I think gold could, the dollar could begin losing ground. Now, there's a possibility that the US Fed has to not only not hike rates, which is what the market's beginning to price, but cut rates aggressively, right? Because they're already above neutral, and they will see this as a growth shock. If the US Federal Reserve begins to cut rates much more aggressively at a time when the rest of the world is trying to fight an inflation battle, then the dollar can see weakness once again. So I think the reasonable probability of the reasonable balance of probabilities is that you see the dollar weakening, especially against the safe haven currencies like yen and like gold. Whether or not the dollar weakens against the INR will depend on where we are settling on oil prices. Here and now, and at the time of recording, the INR is just shy of 94. I think the risk reward is still for dollar INR to go higher rather than lower. It's not a balance of payments crisis, but let's also not underplay the situation. If the current account widens even by 1%, let's say we go from 1.2, 1.3% to 2.2, 2.5%, that sort of range, already this 1.2% deficit was very hard to finance because we were not seeing the capital inflows. It's going to become harder, even if it's a modest increase in the current account and current account deficit, that is. And that's why I feel that the balance of risks is still for dollar INR to go up rather than down from 94.
Right. Now, Bhanu, before we wind up this conversation, people would want to know that what would be an ideal portfolio construct at this moment, mixing equities, gold, and any asset classes. How would you frame it?
Look, I mean, if you think about portfolio construction from a structural asset allocation perspective, I think that will not dramatically change as a result of this, right? I think broadly, the 60-40 portfolio has morphed into perhaps the 60-30-10 portfolio, where you have 60 in equities and 30 in bonds and maybe 10 in alternatives, including commodities, precious metals. I think that probably is the structural asset allocation, which will not dramatically change. Although I will say that even in the structural asset allocation, if the growth inflation mix is changing on the secular horizon, you should expect lower returns. So the mix of A, B, C, D is not going to dramatically change, but the return from the sum of A, B, C, D, we should probably expect a slightly lower return. That probably is the easier part of the answer. The harder part of the answer is, what are we doing here and now amidst a war? So what are we doing on the tactical asset allocation horizon? The reason I say it's a difficult one is because if you look at whether bonds are diversifying equities, no. Is gold diversifying equities? No. So what is diversifying? There are very few diversifiers here. Everything seems to be positively correlated. So what are we hiding in, right? I have to say that from a near-term perspective, if I'm an Indian portfolio manager, then I have to probably take a more conservative approach in the near term, right? Given the initial positioning of the market and given the initial valuations, the risk reward is still one where you probably want to play defense because you're not already defensively positioned. I think you need to play defense. And how do you play defense? I think in the equity market, you probably want to be in the dollar earners. Why? Because the rupee is likely to depreciate, right? So you probably want to be in the service companies, the software, the IT service companies. You probably want to be in pharma, and you probably want to take a much more conservative view on the consumer, right? I would have ordinarily said consumer and financials. Financials have already adjusted quite a lot. They can certainly lose more, but the consumer, I think, is where we could come under, under greater scrutiny. Autos, for instance, consumer services, for instance, even the FMCG sector, which is usually a defensive sector, is getting hit because of the packaging that comes from the petrochemical products where prices are going higher. So I think for me, this would be, if I have to simplify this, it would be a more defensive portfolio within equities, and consumer is the place where I would be most conservative, and the exporters is where I would be hiding. And I would also say that the fixed income market is where value is likely to be created first. 4 hikes already priced in, with no cuts later, I already find that attractive. The long end can sell off a little bit more. You're at 6.8 on the 10-year. You could probably move 30, even 50 basis points, but then I think there's value being created out there. So in the near term, I would be playing a more defensive approach, both within the equity market and also with overall in the portfolio. I'd be taking a greater view of being long in the near term, tactical asset allocation, right. 3 months, longer fixed income, front end primarily, but also the back end with a little bit of adjustment over equity.
Great. That was a great conversation. Thank you, Bhanu, for joining us.
Thanks a lot.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Vinay Joshi and Rajas Naik. Sound designed by Amrit Reggie. This is your host, Nishanth Vasudevan, signing off. Keep listening.